Good morning. Hope you're all having a lovely day. Today's presentation will be taken by Mr. Rajat Setiya, co-fund manager at iThought. How easy is it to time the market? Does the perfect moment to invest even exist? Timing the market does have its benefits, even though it is a hard nut to crack. But is it even wise to attempt it? So many questions crop up, right? In this webinar, Mr. Rajat will be answering the most widely asked questions using empirical data and history of markets. Without further ado, let me pass on the podium to Mr. Rajat. Thank you.
Thanks, Tarun. Good morning, everyone. Thank you so much for joining us today on a Saturday morning. So, it's the most commonly asked question in the market that, is it a good time to invest? So everybody would want to try to time the market in some ways because opportunity cost of capital is everything, and it's not a bad thought to have. However, how practical is it? Is it something that we can really do it, or is it our illusion? Let's dive in. Let's begin with what how experts have done on this metric. So this slide is basically a compilation of all the clippings, what all was said during the peak of the COVID crisis in March 2020. So these are all legendary investors and their quotes here. And what they were really essentially saying in March 2020, they were saying that we are going to have the worst bear market in their lifetime. And we all know what really happened after March 2020, not just in India, outside India as well, all over the world. We saw a very fantastic bull run. Same news clippings around the COVID times, which were predicting gloom times in the future. Let's also look at, given we are in the middle of elections in India. So what really was predicted around the election times? What was market verdict about the election results, and what really happened? So when UPA 1 government came into power in 2004, it disturbed it. It was against the expectations of everybody. Everybody thought that BJP will come into power, and hence on the victory day of UPA 1, markets tanked big time. It was the steepest drop in the history of the markets of the last 130 years. But look what really happened after that. India witnessed the highest economic growth phase that it has seen in the last, since independence. And then we also saw mother of all bull markets in India. So really, whatever was the prediction on the election day completely was proven wrong. Similarly, in 2009 now, when UPA 2 came in, so markets thought probably, experts thought probably that UPA 1 was a good thing for the markets, for the economy. UPA 2 will also be pretty good. So see what they said or what really happened. Two upper circuits in one day for the index when UPA 2 came into power. And what really happened after that? India witnessed very weak economic growth in the 5 year time period from 2009 to 2014, very high inflation, deteriorating macros, and poor stock market returns. Another set of predictions around the public sector stocks. In 2010, it was said that UPA 2 will probably bring a boost to the public sector stocks. And in 2014, we had, the headline said UPA takes sheen of public sector stocks. So it is not really easy, not to blame anybody. Uh, Everybody has their views, they have analysis, they then talk about what might happen, but it's not easy. The point of these headlines, these clippings, is to tell that it's not easy. So experts get it wrong as well because it's not easy, and it's not probably possible as well because we are talking about future, and who knows future. So let's also look at data. In the last 90 years, if this data is basically a S&P 500 index of US, if somebody invested some money in 1930 and that person stayed invested for 90 years till 2020, it's a long period of time. But the data says that if you were invested, let's say you invested 1 lakh at that point in time and you stayed invested till 1930, your money would have become 1 crore and 77 lakhs. It went up by 177 times in 90 years. However, if you were doing in and out of the markets and in the process, you end up missing top 10 days of the decade and in total just 90 days out of 90 years. If you are not there in the market, your returns, your 1 lakh, which became 177 lakhs in 90 years by staying invested, that same 1 lakh, if you miss the 90 days, best 90 days, will become only 1 lakh and 28,000 rupees, which is nothing. I mean, all of our returns will completely go away if we just miss the top 90 days. So this is what can happen if we are trying to go do a lot of in and out instead of staying invested. Same is our experience during the COVID times. From the bottom, Nifty 50 index went up by 141%. However, if you just miss the top 15 days or top 10% of the days, which was 39 days, this is the returns that we would have made. So it really means that timing the market is difficult, and doing in and out can result in getting us out of the best days of the market. Let's also look at what it really means. Even if we try to time the market, what we will have to do, we will have to do a lot of buy and sell, take a lot of buy and sell decisions, because the data says that in the last 20 years, every year, the small cap index has fallen by this much. Every year you can see index is falling by 10, 20, 30, 40, 50, 60, up to 70%. So every year market is going down by this much in between. So we will have to, if we are running a portfolio of 10, 20 stocks, every year you have to take so many sell decisions and so many buy decisions. That's one. And second, in the whole process, we may end up selling our winners. Sometimes you sell something in the hope of buying it again, but that's not always possible, because what we think will happen may not happen. And we have seen how experts have done on that metric. It's not easy. What is the workaround? It's simple. We need to be patient, and we need to just let our good stocks do their job. So why do we feel that it is okay that we do not time the market, and in the process, if our portfolios are falling in line with the as per the stock market corrections, why is it okay? Because it is really the prices that are falling and not the value, and there is a difference between the two. Value of a company that you invest in is completely different from the prices. Value is the worth of the company. Prices is something that market ascribe to that company. The value, in markets term, what is the value of the company? The real worth of the company is what we are calling as value. So market prices can be very different from the real worth of the company, and that's what our job is. So as long as it is the prices that are falling, we should be absolutely fine. But if it is the value of the company, we need to be careful. So we need to focus on the value, not the prices. The prices going down or going up is nothing but an opportunity to participate. Whenever prices are falling below the value of the company, it is an opportunity to participate in this volatility, and only somebody who has a long-term horizon can do that. For somebody who has a short-term horizon, price is everything. But for somebody who has a long-term horizon, what really matters is the worth of the company. And if it is selling at less than the worth of the company, if the price is less than the worth of the company, you go and buy. So despite knowing, and these things that we have just showed you is something that we have picked up from newspaper clippings, some of the analysis that we have done, which is also available in newspaper articles and all. Everybody is going through it, is seeing it, and yet we try to time the market. Why? So answer lies in the way our behavior, human behavior works or our mind works. So what essentially happens is that we always try to give lot of weights to our abilities to predict something in a short period of time. We might end up saying very casually that markets can go up tomorrow, next week, elections are coming, market will go up in the next 3 months. We always hear such statements, very, very, sweeping statements all the time, because we generally, it's just the way our mind works. We generally feel okay. We know we can predict something in the near future. But when somebody asks us what will happen in the next 10 years, it's usually we find it difficult to comment on that question. And this is what exactly Bill Gates has said about. So our brains are actually wired in a certain way, and there is a popular saying which says a bird in the hand is worth two in the bush. So whatever you have got today, value it and move on. So same thing gets applied automatically without much thought, that if you have made money in the markets in a quick short term, you just take the profits and move on. Don't worry, or don't even think about what will happen in the next 5 years or 10 years. That is again something that stops us. And this is exactly how our brains are wired, and we need to understand and act against it. So what shall an investor do after seeing, or after having the proof that even the predictions is not possible even by the experts? So what should we do? And we are no experts of predicting. We don't have crystal ball gazing abilities. So what should we do? As we have seen slightly in the past slides, that it really pays to have a long term horizon and data. Once again, we are using the data here. We are not giving our view. It's the data that we are seeing over the last so many years. So this data, what does this slide says? Over the last 20 years, if you were an investor on a daily basis, 42% of the time your returns were negative. However, if you slightly increase your horizon, you will see improvement in your returns on a rolling basis. If you were an investor on a monthly basis or 3 month basis or 3 year or 5 year or 7 or 10 years, you are seeing that percentage of the times your returns are negative is falling. So this is clearly the power of long term. The more the horizon, the less the chances of making negative returns. Few more slides on the power of having a long-term horizon. So this chart is Nifty Small Cap Index. As you can see, from 2004, it's a 20-year data. From 2004 till today, chart has gone up a lot from previous peaks. It always ends up making new peaks. It can take time, but that certainly is happening. However, in the meantime, look at the flow of negative news. This is none of these annotations that we have put here is positive. Every news item is negative. And during every negative event, markets have reacted negatively as well. We are not saying that markets have ignored that and every time market was going up. No, in a short span of time, maybe during that week or during that month or during that 1 year or 2 year time period, markets were in negative. However, if you had a long-term horizon, you can see what's really happening to the index. It's just going up. Similarly, same index. By the way, during this time period in the 20 years, index has given 15% annual returns. 50 lakhs invested can become or would have become 8 crores. This is 15% compounding over 20 years. And during this time period, many crises have happened, and yet the great outcome. So, despite so much of negative news flows or crisis, market is going upwards over a long period of time. So, it is basically the itching to predict something in the short term that leads to, or that leads to basically us predicting the markets and trying to come out with a great outcome despite knowing well that chances of failing are high, and most importantly, we our objective, what is our objective? Objective is to create long-term wealth, and that long-term wealth can be created without trying this strategy, which is sure to fail, because even experts have got it wrong. So what is the key learning here? Learning is what we have already talked about. We need to stay invested, but that, we need to have a long-term horizon. We need to stay invested so that we can take advantage of these market volatilities. And during these volatile times, markets is throwing a lot of opportunities at us. But our fears about losing money in the short term really hampers our rational decision making. And that is something that we really need to work on and then take the advantage. And using the data and some of the previous slides that we have shown you, this is how we can try to overcome our fears. Few more slides in a different way showing the benefits of long-term investing and staying invested above all. We can be long-term investors, but if we are doing a lot of in and out of the markets, we are interrupting the power of compounding, which is said to be the eighth wonder of the world by great mind Albert Einstein, who himself said that probably compounding is the eighth wonder of the world. The one who understands compounding takes advantage of it. The one who doesn't understand compounding pays for it. So what really it can do to us is, let's look at it. So let's say in year one, we invest 50 lakhs. And after 20 years, if we are able to compound our portfolio by 15%, just the fixed sum of 50 lakhs, if we are able to compound it over 25 years by 15%, our portfolio value becomes 16.5 crores. So you have a long-term horizon, then you stay invested, which means you let the compounding do its job without interrupting it. Then all you have is got magic. This is really magic that 50 lakhs becomes 16.5 crores after 25 years with 15% interest rate. And to show the power of compounding, once again on the next slide, how it differs from this current slide is, instead of 15%, if we just increase our returns by 20%, so 15% becomes 18% on an annual basis, what kind of outcome do we see? And that's where we really see the power of compounding. With just a difference of 3% on an annual basis, our portfolios almost double in 25 years. That same 50 lakhs, which became around 15 crores, is now 31 crores in 25 years. Now let's look at another aspect of investing, which we really emphasize at iThought, is the power of SIP. So can we really say that SIP is the ninth wonder of the world? We don't know, but we can certainly say it will help you compound your net worth in a drastic positive way, and it can really create a lot of wealth over a period of time. Look at this example. Same 15% compounding, however, with a SIP of 50,000 per month for first 10 years, and then 1 lakh per month for next whatever remaining time period. So you begin with probably 10% of top up on your portfolio value on an annual basis, but that percentage goes on decreasing because your portfolio is going up and you are keeping the SIP amount as static. In 15 years, when you were making only 15, 16 crores after 25 years with 15% annual returns, with the power of SIP, that number is now double of that. And with 18% compounding and the same SIP, you can see you can again double the amount to 55 crores. So almost double that. So this is the power of SIP. This is why we always emphasize on SIPs. Now, so far we have talked about, how timing the market can really be disastrous. You can miss out the best days, and how you can counter that is by staying invested. And there are benefits of doing that, and we have seen that. Now let's turn our attention to Vriddhi. How we at Vriddhi have done, and what is our recipe to do that. Here on this slide, we have divided all the Vriddhi clients into different categories as per their timing that they joined Vriddhi. First category we have highlighted for a reason. The reason is when we started this first set of clients, it was in November, December, January time period, November, December 2017, January 2018. In hindsight, that turned out to be the peak of the markets, and market small cap index witnessed the second most severe correction that it has ever seen. Index corrected by 66% during this time period, and the correction lasted for almost 2 years. So just imagine the kind of pain everybody had gone through during that time. There were many reasons why market corrected, but none of that was visible at that point in time. Only in hindsight you can say, oh, that was the reason. So we ended up having a very bad time in terms of starting the portfolios, right? Because markets corrected big time after that. 2 years, 65, 66% correction in the small cap index. And yet, look at the returns. So not just our returns, look at the index returns, 16% from there. So, and our returns almost 30% from there on an annual basis. So how did that happen? Let's look at that. So this is our way of investing. This is our philosophy at Vriddhi. And we can proudly and comfortably say that this is also our philosophy at iThought. Every product at iThought does follow this philosophy. Now let's talk about Vriddhi here. What we really like to do is we like to invest in companies which are hidden from the market or the crowd in general. There are no big investors in that company, not much coverage on that company, and they are leaders in their space. They are number one, number two, number three, most of the companies in our portfolio. Second, we like to invest in companies which do not have much debt or they are debt free. Debt is the prime most reason why companies go bankrupt. If you do not have debt or any obligations, financial obligations to somebody, like a bank, why will you ever go bankrupt? You will simply stay present. You will simply stay as a going concern. You don't have to worry. You can go through downturns, but you will exist. But if you have debt, you may go bankrupt. So we like to invest in companies which do not have much debt. Then high corporate governance, which means management or the promoters are ethical. They have displayed through their actions over the last 10, 15, 20 years that they are minority friendly, and they have the capabilities to take decisions during tough decisions during bad times, and they have executed brilliantly. And finally, we'll seek a lot of margin of safety, which means here we are defining margin of safety by entry valuations. It is one thing to buy a good company, and completely another to buy a good company at a good valuation. So we pay a lot of attention to valuations because they contribute a lot to your returns. So diving in, uh, talking about the kind of companies, we have picked 6 names here, which were 4 of them were market leaders in their own chosen niches. 6 names that we have picked are all very small in size. As you can see, the entry market cap, and touchwood, they have done really well for us so far. So idea was to is always to invest in companies which are not really covered and not really invested by institutional investors, so that when you invest in them, uh, their re-rating chances are high and you can easily get into them. And when the bigger markets or more people discover it, more money is made. Then we focus. So in the previous slide, we talked about what kind of companies we like to invest in. Now we will talk about risk control process. So we focus a lot on risk control and what we should not do. So we do not really focus a lot on maximizing our returns, that we chase returns, we have some target in our minds, and we just drive all our decisions by that. No, that's not how we operate. Every decision at Vriddhi is taken from the sole point of view of reducing the risk. And risk we simply define by by calling it loss of capital. If we're going to lose money, that is the risk we have. Let's try to reduce it at portfolio level. So in the previous slide, we talked about what we do, what kind of companies we invest in. Now, on this slide, let's look at what we, it is also important to not do certain things because they can kill you. So what are those things that we do not do or we avoid at any cost? So these are some of those things. We really do not like to chase momentum or invest in the hot sectors. For example, today, electric vehicle, electronic manufacturing services companies. Issue is whenever something is really hot, there's a lot of demand and the price of that company or the whole sector goes drastically up, leading to very high valuations. And usually, more often than not, history is testimony to that. If something is very highly valued, there are very low chances of making money from that point in time. So what do? You wait. So we have talked about certain very visible, tangible aspects of the investing that we do at Vriddhi, what we do, what we don't do. However, let's talk about very softer aspect of investing, but a very, very crucial aspect of investing and the most underrated virtue in investing in our view, and that is patience. We really need to be patient. If something is in the trend, something can grow for a long period of time, like electric vehicles or some other hot sector, and the valuations are expensive. We need to be patient about it. We need to wait about the right valuations because valuations contribute almost one third of our returns. We have done one analysis in which we also talked about in one of our previous webinars, is that valuations contribute one third to our returns, and that's not a small number. So we need to be really patient. So why are we saying we really need to be patient? Because the data says in the last 10 years, small cap index was trading 30% or more down from its peak for 22% of the time, and 20% or more down for 35% of the time. So market is giving you opportunities, and it's gonna give you opportunities. But how do you take advantage of it? By being patient. Your time will come. We will see those opportunities. We will have that time, but we need to be patient about it instead of hurrying and investing all our money at one go by doing momentum investing or chasing the returns. So moving on, talking about another aspect of how we operate at Vriddhi, it's all about capital deployment. This slide is all about capital deployment. Next few slides, and working and keeping your ideas ready and using patience to your advantage by being prepared, by being ready. So if you are not really investing money in one go, so you will end up sitting on cash, and that cash can actually be used as a dry powder. And this is what is needed in investing in our view. And this is what we have been doing for a long time. And this is what has really worked for us in the last 10 years. So we need to be positioned in the market so that we can take advantage of market volatility. However, alongside our positioning, what we really need is some cash. Whenever there is volatility, we can deploy that cash. And we have done that to our advantage. Uh, Whenever there has been some correction, we have been able to buy certain ideas which probably we were waiting for more than 5 6 months or more than that, and whenever the prices have fallen to our buy range, we have bought them. So this is how you take advantage of market volatility, by being patient and doing your work and being ready. uh, right side of this slide is showing that there are many ideas that we have in our watch list, and if a correction of certain number happens in those ideas, this is the deployment level of cash that we can do very quickly. All we have to do is just wait for that correction to happen. So showing you the examples, live examples from our portfolio about the capital deployment that we just talked about, that waiting for the right valuations of the companies that we are interested in. So depending on whether market is expensive at a point in time, or in generally stocks are expensive or not, this is how our capital deployment has looked in the past. So talking about a client who real client who joined us in May 2021, the time when Vriddhi was started, it took us almost a year to deploy the capital because we found the stocks that we were interested in were expensive. So we waited. We either we how did we end up deploying most of the capital? We got new ideas, and whatever small corrections happened during this time period, and the pipeline of ideas that we had ready, we ended up deploying in those companies and took advantage of the market corrections. Then 1 year later, if somebody was starting out in May 2022, within 3-4 months, you can see we were able to deploy almost 100% of the capital. And the reason for that is the market was in a correction phase, and the companies that we were interested in were selling for very attractive valuations. So we ended up deploying the capital because the companies that we were interested in, they were selling at a very good valuation. We deployed the capital. Fast forward to the current times, as you can see right now, almost every stock is not really attractively priced, and we are finding it difficult to deploy capital. So our capital deployment strategy is all bottoms up. We go company by company to invest the capital so that we are ensuring that every investment that we are making at a very attractive valuation. Instead of rushing and deploying all the capital using the model portfolio approach, ignoring the valuations, which we have seen that is a major contributor to our returns. So it is not the model portfolio approach, rather it is the bottoms up approach, which takes care of the temperature of the market. Because if individual stocks are expensive, which means market at a broader level may be expensive as well. So we look at individual stocks and then only we invest if the valuations are in our favor. So this is another very important aspect of our investing at Vriddhi, that capital deployment can really create a lot of difference in the outcome that we expect to generate. However, it comes with its shortcomings. In a short period of time, if we are not really deploying all the money at once and markets are going up, then we will end up underperforming the markets. However, it is absolutely fine for us, and that's what we also expect from our clients, that they also understand this aspect very well, because it is a very crucial point we are talking about here, that in a short period of time, even if we are underperforming in a rising markets, we are absolutely fine with it, because we do not want to take the risk of losing money by deploying capital at expensive valuations. So we are not here for 2, 3 months or 12 months or 18 months. We are here for 4 to 5 years and even longer. If the companies in our portfolio are doing fine, we are going to stay invested for even longer. So we are here for a long-term wealth creation, not for short-term wealth creation. And in the short term, if we are underperforming, if we have to go through a pain in the short term, we are absolutely fine as long as it is resulting in long-term gains. So we have talked about our way of investing, but given we have been operating for years now, let's look at how Vriddhi's investment philosophy has been in action. So we have talked about that, we like to invest in companies which have strong balance sheet, which means very low debt or they are cash rich. So at the time of our investment, this was the scorecard of certain companies, of our winners. After we invested, look at the scorecard. Cash rich companies moved from 11 to 15, and same was the case across other metrics. Like profit growth, when we invested, 5-year profit growth was 16%, but after our investment, that growth was 38%. Same is the case with return on capital. It used to be 15% at the time of our investment in all the winners that we have had so far. But after we invested, the return on capital metric improved automatically because profit growth was higher to 22%. So we have been able to identify companies using this approach, which were improving, which were going through a good phase. Same is the case with the valuations. We bought deep cyclical companies at around their book value, and companies which were growing year after year, we bought them around 15 times their earnings or operational cash flows. We think this is 15 times is a very good entry valuation. parameter, especially given the fact that our broader index has traded at around 20 times, and the companies that we like to invest, they are debt free, they are growing in their and run by their good management teams, and they have good return ratios, no balance sheet issues, which is better than on an average than the characteristics of the index. So, which trades at 20 times. So, buying such company at 15 times is absolutely uh, good multiple in our view. And these entry valuations have resulted in good outcomes for us. So, in summary, this is our philosophy, and we have seen that playing out in action as well. This is a list of all our winners and how they have behaved after we invested. So this is how you can achieve great outcomes. Again, a quick snapshot about what we have talked about, that we invest in leadership companies which are market leaders, which are debt free, which are not covered by any research houses. So majority of our companies fall into these categories. A quick snapshot of the performance wise, one point to highlight here: although sales growth has been same as the last year, like FY23, however, EBITDA growth has been much faster, because last year in FY23, generally every corporate was struggling because of inflationary pressures all around the world, supply chain issues because of war and all, and high freight charges and high fuel charges. But in this year, that fears, and we have also talked about in previous webinars, that we expect, for the good reasons, that these inflationary pressures will not be there in FY24, and the same touchwood has played out in that way. And earning growth in the Vriddhi portfolio companies has been pretty good, far more than the revenue growth. Very quickly about performance of Vriddhi. Let's look at since inception number. That's the longest time period we have. We have been able to do decently well by generating. By the way, these numbers are after the fees that we charge, and all the transaction related cost. Comparing Vriddhi with all the major indices, small cap or the Nifty 50 or the broader market, Nifty 500, BSE 500, comparing Vriddhi with these three indices, if 100 rupees were invested with Vriddhi, they would have become 240 after fees and expenses. And you can see the different outcomes if the same 100 rupees was invested with different indices. So touchwood, we have been able to outperform every index. So just to conclude, timing the markets is not easy. Experts get it wrong all the time. So who are we to then predict the markets? Data suggests that we need to have a long-term horizon, and we need to stay invested, because if we are doing in and out of the markets, we may end up missing the best days. Because markets never work in a constant fashion. It's very volatile. In a week, it can give you 1 year of return. So we want to be invested, and unless we are positioned in the market, we can't take advantage of market volatility, which we can do by putting more money. If we are already in doing that by investing in SIP fashion, automatically that money is being used to take advantage of market volatility. And by staying invested only, we can unleash the power of compounding. Otherwise, that disturbing that compounding is not going to result in the best outcome. And at Vriddhi, we have talked about what we do, what we like to avoid, but every decision that we take is from the point of view of reducing the risk. We never chase returns. Again, I'm just reiterating the same thing. We never chase returns. We only chase minimizing risk. We want to control risk as much as is possible. Mistakes still happen, and that is the reason we want to ensure that the number of mistakes or the quantum of mistakes or the heavy mistakes that can happen, we reduce them. And hence at portfolio level, we are able to have an outcome which we really want. And capital deployment strategy, the last point would highlight is that capital deployment strategy of Vriddhi that we talked about really helps us in controlling risk. How? By not investing all the money on day one or in week one in the markets, irrespective of the valuations. Valuations are important. Entry valuations contribute to one third of the returns that we have seen using the last 10 years of data. So it is a very crucial aspect of investing that we use capital very judiciously instead of mindlessly deploying that capital in the first week itself when clients give you money. So with that, I will stop talking about Vridhi and everything else. Next, last two slides very quickly about our team. This is the whole structure of Vridhi and sorry, of iThought research team and the fund managers team, and what different offerings by our iThought PMS. The first one, the flagship product of Solitaire, wherein we are very mindful of generating risk adjusted returns, wherein we take as minimum possible as we can go in terms of taking the risk, however generating, or in other words, generating maximum returns with minimum unit of risk that we take. And then True Blue and Solitaire is a multi-cap strategy wherein we invest across market caps, unlike Vriddhi, which is only focused on small and mid cap. Then there is second offering, True Blue, wherein we invest in bluest of the blue chip companies, which have in them to become big. They're already big and they can continue growing with very low volatility in the portfolio. Third was Vriddhi, we talked about, and the last one is Fair, wherein we invest in multiple asset classes, not just equity. The first three offerings by iThought that we have talked about are all equity offerings, but the fourth one by us is multi-asset investment class, wherein a lot of focus is given to the macros. With that, I'll finally take a pause, and now we are ready to take any questions that you might have. We encourage you to ask as many questions as you can, and we'll start taking all the questions one by one. You can write it in the chat box and we'll start answering your questions. Thank you so much for patiently hearing. So you can type your questions in the chat box. Okay, so we've got the first question. Is the market highly overvalued right now for all the market caps? So going by certain indicators that one can look at, we can say, on a spectrum of highly undervalued to highly overvalued, we are definitely past the midpoint towards the highly overvalued spectrum. So markets are not attractive as such from the macro points, from the broader aspect. However, in the approach that we follow is it doesn't really matter to us whether markets are expensive or not, or the cheap or not. We look at individual companies. We will only invest in a company when that company's valuation is attractive, because what really matters is how that company is going to do in the next 4 to 5 years. And if the valuations are attractive, you go and buy that company. So this is the approach that we follow instead of giving a lot of attention to markets. Small caps are still going up. Well, what happens at the broader level, at the index level, we really do not like to focus on that. Rohit, you want to add something? You're on mute, Rohit.
Can you hear me now?
Yeah.
Yeah. So just one point, as Rajat mentioned, we necessarily don't look at market levels very closely. But yes, as markets keep going up, your opportunity set goes down, and that's visible in the deployment that we are doing. One small additional point is that we must also realize and understand that the revival in the corporate earnings started somewhere in 2019, 2020. and has been boosted by the uh, the boom in the COVID time, and also the margin recovery that has happened. So usually what happens is whenever there is a revival in the corporate earnings, the markets obviously discount it faster. So now the question is whether the earnings will continue to keep doing well. That's the question that we need to. That's I mean, and at an aggregate level, it is difficult, but at an individual level is what we need to figure out for each company. So the markets going up is on the back of very strong earnings also. So, and that seems to be at least the corporates are in a very good shape. So that should continue. So yeah, so that's what I wanted to add.
Sure. Thanks. So next question is about elections. Do you think elections results will change the current market trend? We have we have seen the last predictions or the outcomes or the verdict that market itself gave to the election results. It doesn't really matter actually. Just imagine one simple company called, just for the sake of simplicity, let's look at one company called Colgate, or let's say Hawkins Cookers. If Modi government comes into picture or doesn't come, will you stop cooking rice? No, you will start, you will go as usual. You will buy cookers as much as you have to. Company called Hawkins Cooker will do well if cookers are selling in the market, which is not a function of which government comes into picture. So price of that company will ultimately, there's a saying, stock share prices are a slave of the earnings. So if the earnings of any company is going up, price will follow accordingly. And if the earnings are going down, price will follow accordingly as well, there as well. So we need to focus on companies that can do well in the next 4 to 5 years. Yes, because of elections or something else on that day, in that week, in the ensuing weeks or the months, markets may react in a certain way. And we have seen 20-year chart of that's the historical data that we have. And that is our guiding light as well. In a 20-year time period, we have seen what is happening, or even in a 10-year time period. We also saw that on a rolling basis, on a 10-year rolling basis or 5-year rolling basis, we are not losing much. Negative returns are very, very minuscule of the time. So what really matters is, even if markets are correcting or reacting to election results in a short period of time, that's more of an opportunity if we are a long-term investor. So instead of worrying about it, let's be prepared and let's take advantage of it. And you can't take advantage by sitting from outside. You have to be in the market. You have to do your work. You have to be prepared on what stocks you would like to buy if markets are going to react negatively to any certain event, be it election, be it war, be it some macro data, be it something happening in US or around the world. Anything you want to add, Rohit?
No.
Next question is about, if somebody has 5 years of horizon and 50 lakhs to invest in equity, should they diversify by investing in different mutual funds, or should they put in one PMS scheme? Because in a PMS, you have to have a minimum of 50 lakhs. And ultimately you invest all your 50 lakhs in one with one fund manager, let's say. So that's the question. So it will, two things. One very small quick thing is that diversification for the sake of diversification is not really a useful thing. For example, when you invest in with anybody, there is diversification happening there also by investing the money in 15, 20 stocks. Like for example, we at Fridhi, most of our concentration is in top 15 stocks, and overall we have 20 plus stocks because we like to seed ideas with small allocation where we are testing our conviction, where we are testing how management performs, and we are waiting. And that's our strategy also. We like to deploy gradually instead of deploying all the money in one go in one stock. So gradual deployment really helps us. And we have seen time and again that, gradually deploying money really creates wonderful results for us. By, when you are with the company for a decent period of time, then you are more comfortable investing in that company by averaging up or averaging down, and then you can deploy a larger portion of your capital, and you can be more confident about that capital, and chances of losing money are already going down because you understand that company very well. So coming back to the point, we were saying that we like to seed ideas, and hence overall we end up having more than 20 stocks. The tail end is huge with low allocation. Coming back, even if we invest in one product or one mutual fund or one PMS product, there is anyways diversification happening with 20 stocks or so. Now, if we invest in more than one product, so there are 40 ideas, let's say every product has, and every mutual fund actually has more than 25, 30 ideas, usually 50 ideas. So if we invest in 5 mutual funds, we are investing in broadly 100 unique stocks, which is a big number, too much of diversification. So diversification for the sake of diversification is not good. What really matters is you are carefully investing capital. And as long as you trust the fund manager or the fund house, that the kind of decisions that they take, whether it suits your way of investing, your risk appetite, and whether most importantly, whether the fund managers are walking the talk or not. Most important aspect of investing is that. And if the fund house is slightly old, that they have a track record, then you can go back, read their newsletters, what they said, go through their previous webinars, previous interviews, what they have said, whether they have done in that, taken such decisions in that manner or not. Judge by that instead of just going for diversification for the sake of diversification. Rohit, you want to add anything?
Yeah, I think I just want to maybe stress the last point. I think most important thing is to acquaint or be comfortable with the money manager who you want to go with, whether it is mutual fund or a PMS or anything else, because that is what you should you will have. I mean, that will enable you to be with them for a longer period of time, which is what matters. So I think spend a lot of time in understanding the investment process and the philosophy, whether it suits you as an individual, because there is no one way to skin the cat. There are many ways to earn money in the markets, and there is no right way as such. So you have to be comfortable with the people or with the fund manager or the managers, as the case may be. So rather than focusing on whether to invest in 5 mutual funds or in one PMS, I think focus on finding the right philosophy and then figure out who are the people who are following that philosophy. And from there, you can either pick all of them or some of them or one of them, as the case may be. There is no much difference, in terms of a mutual fund or a PMS. If the investing is done right, then I think it should be fine in either way. Yeah, that's what I wanted to add.
Yeah, because diversification is anyways happening by owning 20 stocks or so. Yeah. The other next question is about valuations. So what metrics do we use in current market scenario when stocks arrive in valuation zone? So in previous one of the slides, we showed you that price to book is one metric that we use in certain cases. Price to earning was another. So it's not one metric actually. It's a combination of different metrics. Our understanding of the company's ability to generate profits and how it can do, and how it is actually positioned right now in terms of debt and industry scenario, the demand growth aspects. So to give you one example, and there none of the traditional metric would really help. So you have to think differently, which is from the size point of view. And one example is that we invested in a very small company wherein that industry is starting out for the first time, and that company is the torch bearer in that industry. It's the first company. It's a very small company. Industry is starting out in India for the first time in the last few years. That industry is starting up, and that company happens to be in that product. Now, industry is small, very small actually, not even 1,000 crores in size, and that company is starting out. So how do you really look at profit after tax or price to book or any other metric? So you have to apply your judgment or use certain other criterias and patterns and all your learnings that you have had so far in the last 10, 15 years, that how big that company can become. What is the opportunity size? So it's not always possible to go by traditional metric. This is just one example, extreme example we are taking to show you that it is a confluence of different aspects of valuing a company that we use and come up with. See, valuation is not a science actually. It is never a science. You can say price to earning is very simple to calculate, but that's not really, if we go by just one metric, we will end up making a lot of mistakes. So it's not a science. You have to go by your judgment over the years that one type of company may deserve a certain valuation, the other type of company may deserve certain other valuations. And in certain cases, it makes sense to give more weightage to a particular style of valuing the company. In certain cases, it makes more sense to give higher weightage to other kind of valuation parameter. So, and always it makes a lot of sense to put together whatever output you're getting from different valuation parameters and then take a call whether it is turning out to be in attractive zone or not. Anything you want to add, Rohit?
No, I think also, as you said, certain kind of businesses may be at a different gestation or the cycle may be very different. So the earnings, just looking at earnings may not be the right metric. Or in terms of many companies, the intangibles are very important to look at. For example, in technology, so it's not a, as Rajat mentioned, it's not like a one silver bullet that you look at. As you keep looking at businesses, you also look at different scenarios, and then there are different sort of frameworks or different mental models that you look at for various kind of opportunities. I mean, so it's very difficult to give you a single line answer, but I think a different every business will have its own, or every industry will have its own valuation framework. Broadly, cheaper P and cheaper P price to book are usually good entry points or good area, good times to sort of get interested, at least for us to start looking at places. But that necessarily does not mean that we will invest. But as Rajat mentioned, and I think there was a slide also, that multiple kind of frameworks that we've used. Some companies we paid a higher price to book. Some companies P was very high when we invested. Some companies P was infinite because there was no earnings. But they were all cheap in our view, because from different vantage points, if you look at it, the earnings were very low, or as Rajat was mentioning, in some cases the industry itself was going through a very bad period, etc. Yeah.
Next question is more about timing, which we have talked about. So instead of thinking whether, instead of seeing investment from the perspective of which kind of companies may be good at a certain point in time, because that's again about timing, we should look at what kind of horizon do we have. If we have a 1 year horizon, yes, it might matter. What kind of companies are investing, at what point in time. But if you are really a long-term investor, which we are at iThought, and our styles are always long-term. So our horizon is always long-term, and we are not looking at 1 year by any means, be it any product that we have, any offering that we have. All our strategies are optimized on long-term horizon. So what you really have to see your risk appetite and your investment style, how risk averse or risk taker you are, what are your returns expectations, all those things, how comfortable you are with volatility, all those things are important. For that, you might have to get in touch with our one of our team members who will sit and discuss with you and understand, ask you a lot of questions so that they can understand, and they will in detail tell you about every product so that you can then match the two, whether your investment style where you are more comfortable, then you will be able to match it with the kind of characteristics that every product has. I think that brings us to, we hope we haven't missed anything.
No, I think you answered everything.
Okay, perfect. So, well, if you still have any more questions, we can wait for a minute or two, and then we can wrap up.
I think we can wrap up. I think there are no more questions, so we can wrap up now.
Sure. Thank you so much, everyone, for joining us on a Saturday morning. We really appreciate you taking our time. We hope this session was informative and useful. We have tried to use the data to really dispel some of the most basic questions about investing. And that was the endeavor that, because data usually will take care of our blind spots instead of judging, or instead of going by somebody's opinion or view. It is the data that matters, because that can open up us to the reality, or help us see the reality. Well, with that, thank you so much once again. Have a good weekend.
Thank you, everybody.